bust a move and get something in here. Quiz. Where's my that's receivables? Where did it go? 4 to 5. Should be right here. Maybe it's under here. That's exam 3. Or is exam 4 must be here? Exam 4. Let's make sure we're not showing any answers, anything. I want to go to, let me pull this up off to the side just in case I get something wrong. Assignment results. And I want to do item analysis for exam 4. Exam 3, exam 4. Review the report. There we go. Okay. I'm running out of voice. Okay. We'll take, looks like we'll try to go through any of them that are like 50% or lower. See if we can work through this. Okay. So let's start out with this one. If the credit balance of the allowance for doubtful accounts exceeds the amount of bad debt being written off, the entry to record the write-off against the allowance results in. Okay, let's think through this. Let's make this a little bigger so we can read it. Move this down a little bit. Okay. If the credit balance, so let's go back to my, where's my T account? Credit balance for allowance for debt. That's a normal credit balance. Okay, so allowance for doubtful accounts. Okay, if the credit balance, so we have a credit balance, so let's say it's 100 and negative, I do that right? Oh, I did it backwards. That's why it didn't make sense. Okay, credit balance there. All right. If the credit balance of the allowance for doubtful accounts exceeds the amount of a bad debt being written off, so this is the balance, this is the write-off. So let's say it's 90. Okay. The entry to record the write-off against the allowance results in. So this entry to record the write-off results in what? And my options are an increase in the expenses of the current period. No, because it all depends on, and they haven't given us this information. It all depends on what the allowance should be at the end of the period. So they haven't given us that information, so that's a no. An increase in current assets, no, because you actually are decreasing current assets with this write-off, right? No, are you increasing it? No, this is a credit. An increase in current assets. The write-off is not, I mean, indirectly is increasing in current assets. The credit balance. I don't see how that works, but it could be that one. A reduction in equity, that's definitely not it, because we're all only talking about asset, a contra asset account. no effect on the expenses of the current period. And that is more than likely. So really, I would have said one of the two, either an increase in current assets or no effect on the expenses of the current period. And since it's a current period evaluation, not a year-end evaluation, I would say that it's just this one, no effect on the expenses, because all we did is we hit an asset account, not an expense account. Okay, so I can understand how that one would probably have been a little bit of a struggle for some. Let's go back. Okay, that one's that one. Let's look at this one. And let's put this above, and we'll see what we come up with. All right, so on February 1st, a customer's account balance is $2,600, was redeemed to be uncollectible. What entry should be recorded on February 1st to record the write-off, assuming the company uses the allowance method? Okay. So if I understand this correctly, then I go back to my good old-fashioned journal entry. I paste it. Let's just go ahead and take this one out because I don't think we need it. Okay. Oops. And we'll just make this a number. So on 2, 1, we're going to write off a balance using the allowance. So we have customer's balance. So we're going to go AR for a customer balance. And that's actually going to be a 2,600 credit because we need to reduce accounts receivable. And then we're going to do allowance for doubtful accounts. Now I'm doing this, not in the traditional debits first, credits second, because I'm just thinking through it. But this is what I think the journal entry would look like before I, move things around. So based on this, I'd go back over to my answers. Bad debt expense 26, credit accounts receivable. Okay, so the credit looks right, but I don't think it's a bad debt expense. So no, I have allowance for doubtful accounts. Debit doubtful accounts for 2,600 and credit bad debt expense. So this one's right, but this one's incorrect because it's an AR account for sure. Debit accounts receivable for 2,600. Nope, that's not right because I got credit. Credit allowance for 26. So this is just flipped, this one right here. And bad debt expense, nope, because I don't have bad debt expense in the account. And lastly, debit allowance for doubtful accounts, got it, and credit accounts receivable. Okay, that's what I would have done. So first I would have written it out, make sure I'm happy with this, and then I would have double checked my answer. And as you noticed, that didn't take me that long for one question, right? Maybe a minute or two, even after I explained it. All right, let's look at this. Reporting allowance for doubtful accounts. Let's pull up our little thingy-mabobber so we can see if we can. December 30, 70,000 of accounts receivable is not collected. Swift estimated 4,000 of its accounts receivable is uncollectible and recorded the year-end adjusting entry. Compute the realizable value of accounts receivable reported on Swift's year-end balance sheet. Oh, okay. So on December 31st, let's go with the T account on this, just to over here, T account. There we go. We got a T account. Okay, we're just gonna put that T account here, and it's going to be accounts receivable. So on 12/31, they had a count 70,000. $70,000 in accounts receivable. I like to make sure that these are okay. That's okay. Swift estimated that 4,000 of its accounts receivable is uncollectible and recorded the year-end adjusting entry. So more than likely, then they had, in this case, let's go back over to this entry, right? They had, I want to say this, bring this over here, and we've got that. So we already got this already. Their first year. So I'm going to say they had no balance at the beginning, and they did an allowance. They set up an allowance for $4,000, right? Now, what they would have done during this, wrong one. I want to bring this one over. Paste. This is a, okay. What they would have done then is this amount would have come over here to $4,000 as bad debt expense. Okay, when they did this entry. $4,000 set up as the allowance, $4,000 in bad debt expense, and then so they're using the indirect method. So okay, so compute the realizable value of accounts receivable reported on Swift's year-end balance sheet. So the net AR value are these two values together. So you got that one minus that one. So you've got 66,000 net real by, oh my goodness gracious, slow down, realizable AR. Okay, put that to the side. On January 1 of Swift's second year, it writes off a customer's account for 700. Compute the realizable value of accounts receivable on January 1 after the write-off. So on 1/1, they took 700 out of here and they put it over here, right? $700 after the write-off. So this is 12/31 and 1/1. It should be the same because we're taking that minus this. All it's done is move things around, unless they've redone this. Okay, so that would be my original take. Let's see how I did. It's exactly the same. See, because they're doing the indirect, the allowance method. So realizable value of accounts receivable before and after. And there we go. They did the exact same thing I did, just in a tabular format. Okay. So that's that one. You know, it's kind of stressful being on the hook for some of these things, don't you think? Note receivable interest and maturity. Let's look at this one and pull up the Excel thing. Okay. So we got used 360 days a year. So on December 1, the company accepts 16,000 45-day 9% note from a customer. Prepare the year-end adjusting entry to record accrued interest revenue. Okay, so first we got to figure out what's our principal, time. Let's call this duration. Principal, duration, and interest rate. Let's call this rate. Okay, so we got $16,000 for 45 days, and it's a 9% rate. Okay, so the interest is going to be principal times the interest rate divided by 360 times 45. Right, so how much interest per day? Because this is not compounded, this is just simple interest. How many interest per day? And you got 45 days. Assuming, so that's $180. So they're saying prepare the journal entry, right? So go back to my journal entries. Where's my journal entry? Got one here. That's easy. Copy. Paste it over here. Make this bigger. Okay. Now let's just take this. So interest, accrued interest. So this is going to be a receivable, interest, what is called interest receivable. Okay, and that's going to be the 180. That's the full amount though. Oh, so tricky, right? That's the full amount, but I only want the amount for the month of December. Let's just figure this out. Okay, so start, end. Okay, so it starts on 12/1 and ends on 12/31. How many days is that? That's going to be that minus that. Okay, we're going to do the same calculation. Interest. We're going to do 16,000 times the interest divided by 360 times number of days. This is actually a days number. And this is a value. Okay, it's actually 120 equals 120. And we're going to set up an interest revenue, or most people call this interest income. Okay, so something like that. And then prepare the entry required on the note's maturity date, assuming it is honored, meaning paid in full. Okay, so let's call this just 115. Okay, and it's going to be maturity, assuming it's honored, meaning that it's paid off. So we're going to get cash of some value. It's going to be the principal plus the interest. Okay, so that's going to be the amount. We're going to have interest, interest income, and that's going to be the difference between the interest income and total minus the interest income we've already recorded. We're going to clear out the interest receivable that's already been set up. That's just going to be the opposite of that one. And then we're going to clear out the note receivable. That's not spelled right, but that's okay. $16,000. That should be our entry. Let's just make sure we can see that. Okay, those are our entries. Now let's check. 120, interest receivable, interest income, or interest revenue. Okay. And then we have the second part, which matches my part, which is right there. 116 and 180, 60. I just have these backwards compared to theirs. And I have the clearing out of the receivable. Okay. Hopefully that helps walk you through how that came together. All right. That was that one. Okay, well, that's fine. I think there's one more at the 50 range. There's two more, three more. Okay, let's see if we can do this. Where was this? Right here. Let's bring this up so I don't see it. Oh, a person who signs a note receivable and promises to pay the principal and interest is a person who signs a note receivable and promises to pay the principal. Okay, well, that is a tricky question. It's not the payee. Let's see if we can eliminate some of these. It's not the holder, because the holder of a note is somebody that receives it, right? I owe you something. You have a piece of paper that says you owe me. The receiver, really no such thing. An owner, I guess you can kind of call it an owner of a note receivable, that they're not. I would not say that they're the holder, because they didn't. Well, two parties could sign a note receivable, but the person who promises to pay is the maker of the receivable. So that's, yeah, kind of tricky here. Payee, I mean, they are a payer, payee, but the payee arguably is the person that's receiving the money, not paying the money. A holder, they do not hold. A person who signs it and promises to pay isn't holding the note. The person that is going to get paid is the one holding it. They're also theoretically a receiver. So a receiver isn't the person who's paying it. The person who's receiving the payment is the receiver. So that's a no. An owner of the receivable, that is essentially the same as a holder. So when I go through each of these, the only one that kind of comes close is the payee, but you really don't call them a payee. It's more like in a vendor, an accounts payable type of situation, not an accounts receivable. So you kind of deduction, I have to go with maker. And obviously that's true because it's a green arrow, duh, Brother Lewis. Yeah, you can see that, but that's how I would probably work through the logic on that if I didn't know exactly, which I don't always know. Okay, let's see. What was that one? Well, that one was that one. Okay, so the other one I wanted to do is this one right here, 46%. And let's get my Excel file up so I don't see it. Okay, move this up. Let's do the math. Let's do the solution. And the asset's book value is $72,000 on January 1. The asset is being depreciated at $1,000 per month. So 72 months, that's what, 6 years? Per month using the straight line method. Assuming the asset is sold on July 1st, on year 7, for $52,000, the company should record. Ooh, that's kind of tricky. All these numbers, all these dates. Didn't want to see that, but let's see. So it's assets book value, not net book value. So book value on January 1, year 6 really means year 0 to me. So book value is $72,000, right? And this is on 1/1. And it's being depreciated at $1,000 per month. So we got to go July. So let's do this in some sort of a year that makes sense to us. Let's make this 2006. Okay, and let's put these in. Give me a short date so we can see the full thing. And then we want to go to 7/1 7/1/2007. Okay, and we sold it for sold $52,000. So now I know the difference between these two values. Let's just call it gross gross value, gross variance, difference, gross difference, okay? Just that minus that is the gross value of the difference, $20,000. Okay. So let's assume we bought it on the on this date. We sold it on this date. We have a gross value of $20,000, but we also have accumulated depreciation. Let's put that over here. Accumulated depreciation. Now that's going to be $1,000 times however many months has gone by. So how many months has gone by? That's the big question, right? Now we can do this a couple different ways. Let's just do it the good old-fashioned way by hand doing it. Number of months in 2006 is 12, plus the number of months in 2007, which is actually 6, right? So January through end of June. So that's 18 months. So we've accumulated $18,000 in depreciation, and we have $2,000. And so this is the net difference, plus that minus this. Okay, so now we have a couple of values to work with. We can see if we can figure this out. What do they want to do? The company should record. Okay, so when it was sold. So once again, we go back to our journal entry. Let's move this over so I can make this a little bit bigger, easier. Okay. We know we have a cash deal. The cash deal is what was sold for, $52,000, right? We also know that we have to clear out the equipment, right? So we're just going to call this we'll just call it asset. We'll just call it an asset. We know we need to clear that out, $72,000. Also know we need to clear out the accumulated depreciation. Now, accumulated depreciation is $18,000 as a credit, so to clear it out, we have to do a debit. So if we just look at these numbers right now, we got 70 versus 72. So we have to balance these two out. We know that this is $2,000, right? So if let me just sum both sides of this equation. Oops. Okay, so now we balance out. So we know this $2,000 gets us to the right values. So the question is that a gain or a loss on the sale of the asset, right? Well, a gain on the income statement, an increase in equity, effectively, an increase in net income is going to be a credit. A decrease in net income, like an expense, is going to be a debit. So this is going to be a loss on sale of the asset. Okay. Now this should be in some form or another. You know, some would say this one, for example, is cut this. The proper way of recording this would be like that, but I just did it in the format of thinking through it logically and trying to see what went where. Okay, so now if I look at my options, neither a gain or loss is recognized on this type of transaction. False. I got a loss. Gain on sale of 2,000. False, because I have a loss. Loss on sale by 1,000. No, I don't have a loss. I have a $2,000 loss. Gain of, no, I don't have 1,000. I have a $2,000 loss on sale of $2,000. There we go. That's the answer. That's how you get there. Okay, let's see what we got. Was that one? That one? I'll do one more. One more. I'm losing it. Total asset turnover ratio. Oops, I didn't want to see the answer. Okay. an asset turnover ratio of 4.5. Ooh, an asset turnover ratio. Let's just asset turnover. Now, this one I have not done in ages, so I'm going to have to figure this out. Asset turnover ratio. How many asset turnover? Asset turnover. Turnover assets. Asset turnover. I'm thinking, how many times does something turn over, right? So an asset turnover, you would have an asset value compared to the total asset turnover ratio. Turnover ratio. Oh my goodness, this is horrible. I'm gonna guess. My guess, because I don't know this offhand, I would have to go figure out what the asset turnover ratio is. But that doesn't help you out if you're taking the exam, right? Because you probably forgot it just like I have. Asset turnover ratio. How many times an asset turns over? So this could be something similar to like, let's see, this is chapter 4, right? So, excuse me, chapter 7 or 8. So this is going to have to do with either, not inventories. This is going to have to do with receivables or something else. A receivable. So on the receivable side, it's AR divided by COGS. And it's, so if AR is $1 million and COGS is, I don't know, 200,000, $200,000, then my ratio turnover is going to be that divided by that. And if I want this to be something similar to like what they have, 4 point, oops. Let's make this 4.5. Data. What if goal seek to 4.5 by changing any one of these numbers, doesn't matter. There we go. Okay. So that's, let's say it's something like that. I forgot what an asset turnover ratio is, so we're just gonna have to punt and see what we got here. Oh, it's a net sales thing. Okay, so AR net sales. Now I know what it is versus assets. Okay, that's going to be our ratio. Yeah, now I know. There we go. Now I have something to work with. So for every dollar in net sales, okay, the firm acquired 4.5 in assets during the period. Nope, that's not what I would imply. Because I would say one to, it's more like, you know, if I did, let's do this. Is this right? Yeah. So, you know, this would be 1 and this would be 0.22, something like that. Right. So somewhere in there. So that's not correct. 1 in net sales, it does not equal 4.5. It'd be 0.22 in net assets. For every $1 in assets, the firm produced 4.5 in net sales. Okay, so let's do this. 4.5 and 1. Yeah, that makes sense. That gives me 4.5. For every 1 in assets, the firm grossed 4.5 in gross profit. Well, even if this was 4. This would be similar to this one, but it'd be focused on gross profit, and most things aren't. This turnover ratio isn't usually termed in gross profit, so I'd say no. For every 1 in assets, the firm earned 4.5 in net income. Usually not, same type of thing. We're talking about assets. as compared to something greater than assets. Usually net income is not greater than than assets, so I would say no there. And for every $1 in assets, the firm paid 4.5 in expenses, and almost never related to expenses, so I'd say no. So this would be the closest that I got just by randomly trying to figure this thing out. And that's what I would go with. All right, so you just saw me get probably all of them right, except for that one. And let's see, this one I would have gotten right. I got it right, but I didn't know exactly what the turnover ratio was. I just knew conceptually what it should look like, and then just adjusted it based on what I saw in terms of sales versus something, an asset, right? Something that's compared to an asset. I had to work through that. I hope that helps. Probably some very confusing logic, but that would be my review of exam 4, and the top questions missed that were more than 50%. Anyway, I hope that helps. Hope you have a great week. Let me know if there's anything else I need to do for Thursday's review or Thursday's office hours. Take care. Bye.